finally did it. Alright. Ooh, that's great. Alright, lovely. So we up and running. Alright, folks. Afternoon. Right, so last week we started talking about depreciation, right? So this is one of the topics that usually is taught in Term 3 in Form 4 that causes a bit of issues for some people, right? In conjunction with the provision for bad debts and accruals and prepayments. You all did those, like the revenue and expense accounts?
Yeah.
Yeah? Okay, good. Right, yeah. And then, of course, all of that is sort of consolidated in the income statement and balance sheet because you have to know how to update those financial statements to reflect these adjustments and closing entries, right? So it's a turning point in the syllabus for a lot of people where they either kind of half understand and kind of limp along, or they don't and they just totally lock off. So hopefully we can help with that, right? Now, even though we're doing depreciation now, and we might probably touch on the provision for bad debt soon, right? I will do it over in July, August, just to kind of make sure everybody gets it, right? So we don't have to worry about if you don't understand that it's totally gone and you're never going to see it again, right? So because we started late, I'm not going to worry to go over the usual recap. But we did a couple of pages with the notes, right? We did what depreciation is, the causes, the rationale. We talked about the matching principle, the prudence concept. We also talked about historical cost, right? Depreciation being a non-cash expense, there's no money paid, all right? And we talked about the two different double entries that we have to kind of talk about, right? There's one that is usually taught at CSEC PO level, and then I mean, the one I did when I went to UE was a little different, and then that's the one you're supposed to know if you go to Form 6 to do accounting, right? So it will be accepted at the Form 5 level, but we'll see. Now, let's today get into the calculations for depreciation, right? I'm talking about the different methods of it. So at the Form 5 CSEC POA level, you're expected to know two methods, all right? Okay, so let me just zoom in here a little bit. Take off that. Okay. So text box go in. Alright. Alright, so the straight line method of depreciation, of calculating depreciation. Okay, so there are two methods you have to know. This is one, right? It's usually thought to be the easier of the two, but it depends on your opinion, right? So let me just give a brief overview before we start jumping into it in a bit more detail. So the straight line method of depreciation, what happens is you have a formula that you can use, and sometimes it'll give you a percentage, and all you have to do is multiply that percentage by the cost. There's even a way to convert the depreciation expense from the formula into a percentage, but we'll talk about that in a little bit. Now, the major characteristic you need to know about the straight line method of depreciation is that it results in the same charge, or the same amount being charged for depreciation every year. Alright, so under this method, the same dollar amount is charged for depreciation every year over the assets estimated useful life, or EUL. Alright, so the formula is as follows. Right, so we have the cost of the asset, and we have to minus something called the residual or scrap value, and divide that by the EUL in years. Sorry. gives the depreciation expense per year involved. Right? And this is another word, cost, right? Cost is equal to the list price of the asset plus any and all other incidental costs of acquisition and of putting the asset into operable or saleable, operable use or saleable. Come on, Philip. Okay, so let me explain that. Now, we talked about this already last week, so I'm just putting it here to remind you. It's not something that comes up very often in the papers, but it's something you need to know anyway, because it can come, and it has come up once or twice. Once recently, I think it was Jan 2024. It was last year for sure. It wasn't this year. All right. Okay. So when I say cost is the list price plus any and all other blah blah blah. So like I said last week, if you go on Amazon, like we do, right? Aqua Monster. No, we're doing PoA, Form 4 PoA now. We're doing some maths later. We add maths. I might have to just open up some videos on my channel for you all, but DM me now, we'll talk. Anyway, yeah, sorry. Right, so, okay, so forget Amazon for a second. So let's say we went from here, we took a little drive down to KFC, or some of the kids did a couple, so they walk down and come back, and they walk real fast, because they really want to class start. Anyhow, so if you go to KFC now, and you say you want a character special or a special, you pay $40 and you walk back or you drive back. If you say, hey, I don't have a car, I want to walk, I'm going to call KFC and they're going to bring it. And when they bring it, you have to pay them $40 for the thing, but plus $25 for the delivery. So you're paying $65 for that food, right? And when you say, no, what, this only costs $40, $25 delivery, right? But if you didn't pay the delivery, you couldn't get a sandwich. So anything you have to pay to get what it is you bought, because that's not bothering them, I could indicate with that, right? Anything you have to pay to get an item to you and to be able to use it is part of the cost, right? So if we scale it up now to, say, like ordering from Amazon. So again, tell a couple things out on Amazon for like 99 cents. Like back in the pandemic when I discovered you could order, there were a few books I was kind of eyeing on because I wanted, right? And then I like, what's this used thing? And I seen used acceptable 99 cents. Like, well, that's way better than 25 US, and it's acceptable. Okay. I used to look for like very good or like new, you know. And you were still get pretty good prices, yeah. I mean, I had to wait a couple extra days, but what's that? I saving like 10 US at a time, you know. But anyhow, when that gets shipped to the Skybox place in Miami, or wherever in the States, right? They'll charge you to ship that down here. So you have to pay them that. And then when you go to collect your book, you have to pay the clearance fee or whatever it is, right? Now, I don't think books attract much duty. They used to attract none at a point in time, right? But of course, things change with different government regimes, right? Anyhow, so but when I get the book, it's not just 99 cents a pay for it, it's 99 cents plus Skybox shipping from Miami to Trinidad plus whatever clearance fees, right? So it might come up to, so instead of just 99 US cents, just like $7, it might come up to about 150, right? So that kind of kill the whole vibe. Just make you want to just buy stuff on Kindle and call it George, which I did. I actually bought about a dozen Kindle books. No, it's not the same. It's not the same. But and then I don't have a Kindle. I have this. So I was reading books on my phone. So not the best experience. What topic in accounting is the most difficult? It depends on you. Some people find certain topics very hard. So I'm not going to name a particular one. Anyhow, yeah. So it depends on, right. Now, I have a couple of words here, putting the asset into operable use, right? Operable comes from the word operate, or operational, right? If you buy, for example, a computer, and they say, all right, cool, and they bring it to you, but you have no idea to set it up. Can you use it? No. To be able to use it, you have to pay someone. You might have to pay someone to come and help you. And whatever their fee is for setting up your computer, that's part of the cost. So anything you have to pay to get the asset to you and to be able to use it, right, to put it into operable use is part of the cost. Then I have saleable form. right? Let's say you were buying stuff to sell. So let's say you're bringing stuff in from Amazon to sell. And let's just say that time you happen to have some extra cash and you bought a couple of computers and you brought it down and say, hey, I'll sell this cheaper than them stores anymore, right? And your computer, it came down where your phone box was kind of damaged, so you opened just in case and you found little pieces detached, your screen and a thing. So you had to buy parts to fix it up, right? So if you didn't buy those parts and didn't pay someone to fix it up for you, could you sell it? Not really. You might have to just take a loss on it. But now that you fixed it up, you could sell it. So you put it into saleable form. So anything you have to pay, anything in order to get the asset and to be able to use it for whatever purpose is part of the cost of the asset. Alright? Now I'm putting that there because I want to cover my bases, right? To make sure I've given you all proper definitions for everything, right? Okay, so that's cost. So now we have residual or scrap value. Whoop. Right, so sometimes we will fully use all an asset. For example, a couple of the cars we have here. So there's a PBG one that was bought in 1999, and a whole different century, a whole different millennium, right? So that car is kind of old, right? So yeah, about 25, going on 26 years old, right? Now, people will still pay money for the parts of the car because it's in workable form. I actually not you all, but there was a parent who actually asked about it. They're like, hey, if you're not using that, I'll buy it. I'm like, oh, okay, cool. But yeah, my dad put too much work into that car to sell that, so that happened. But anyhow, so if, let's say for example, we say, hey look, we find the car, we want a new one, let's get rid of this one. And we said, okay, it's worth 40,000 TT, right? So we decided, hey, that is the residual value or the scrap value, right? So residual comes from the word residue. You all ever did like science where you had filter paper and then experiment? Yeah. And when you pour some stuff in the filter paper, there's stuff left in the filter paper, and that was called the residue, right? So residue is what remains or what is left back after you've finished with something. So residual value is the value that remains after you've finished using the asset for your purpose. Discount. Well, it would have to be discounted because it would be less. So yeah, in a manner speaking, right? It's also called scrap value because instead of selling the asset for someone else to use, you could sell it for parts or sell it to be scrapped for parts, right? So residual value, so this refers to the estimated value that the asset will have at the end of its useful life. Right? There was something else I had to add to that. Okay, yeah, I'll leave it at that. Of course, the third thing was the EUL, or the estimated useful life. Okay, so this one is kind of straightforward, right? This is simply the number of years which you expect the asset to be in use, right? So now seeing Kiwi send one message. Right? Okay, alright. Before we go any further, Lady and Jensen class, are you all okay? It was on the screen so far? Any questions, anything at all? No? Alright. Haley, you okay with that stuff? Alright. Alright. And Shiloh, how are we feeling with that stuff so far? So far so good, or any questions?
Yes, sir.
Alright, cool. So Keely will join soon. We'll just get some water. Okay, cool. Right, so this is the, like I said, the straight line method, right? The major characteristic you have to know about this method is that it charges the same dollar amount for depreciation every year, right? Now, right, so let me give one last piece of notes before we go into some calculations, right? So this method of depreciation is actually best used for assets that kind of wear out evenly or deliver the same value, about the same value every year over the useful life, right? For example, like in this class, the chairs, the tables, the furniture basically deliver the same amount of value every year, right? They don't provide less value or more value per se, right? It's about the same, right? Stuff like motor vehicles, right? And if the first year of their life, first couple of years, they're providing most value they probably ever will. Thereafter, when wear and tear starts happening, especially turn our roads, right? You end up spending more on repairs, you have things to replace, etc., etc. So they provide less and less benefit relative to the amount it costs to maintain and keep them, right? So in those cases where they provide less and less benefits, we would probably be better off using a different method of depreciation to reflect that. And that's where the other method called the reducing balance method comes into play. But we will talk about that in a little bit, right? Or maybe next week if anything. Okay, so note so the straight line method of depreciation is best used for assets that wear out evenly or provide approximately same benefits every year over their useful lives. Oh, sorry, I pressed the wrong button there. Nikita Williams, I did Nikita. Sorry, I'm not keeping up with the questions, guys. Right. Okay, so okay, can I go on to the next page now? Okay, cool. So sorry, just not saying. Right. Actually, I should have done that. Crap. Okay. Oops, sorry. Alright, so what we're going to get into now, take a look at the notes. Yeah. Alright, so what we're going to get into now is just a couple of, an example with the calculation and the journal, the two possible, well, should I do both at the same time, boy? That may be a bit confusing. So let's do one at a time. Okay, cool. Alright, so actually I will need to change this. So let's do translation. straight line method, example 1. So, a motor vehicle, no, let's use some furniture here. So, a company purchased some furniture valued at, let's say, $10,000 on 1st of Jan 2021. Okay. Right. It is believed that the furniture will last for 4 years and be worth $2,000 at the end of that time. So, using the straight line method of depreciation, calculate the annual depreciation expense on the furniture. Show the general journal entry to record the annual depreciation. And 3, show the depreciation account for each of the years of the asset's useful life. Alright, so okay, so what is the formula? Formula is cost of the asset, right, which is 10,000 minus the scrap or residual value, which is 2,000, divided by the number of years, which is 4. So 10 minus 2 will give us 8,000, divided by 4 will then give us 2,000 per year. So that is the calculation using the straight line method. Alright, so again, it's a pretty straightforward application, right? Now, the general journal entry is basically what account are we going to debit? Because we're accounting, right? We're in principles of accounting. And again, what does account mean? To account means to explain. right? So we have to be able to explain what's happening with depreciation. So therefore, it has to have its own account. Now, like I was saying last week, there are two acceptable methods at the CSEC field. There's the most popular one that has been in use for a few decades now, the one I learned back in the 90s, and the one that's still in most of the textbooks at the CSEC field level, right? Which is it's a debit to the income statement, or profit and loss if you want to call it that still, and credit the provision for depreciation account. Alright? So the Alright, so the general entry would be to debit. Actually, I wouldn't show it in this icon here. Alright, so if you had to head up a general, you head up general. I'll put some lines for those who like lines and this stuff, right? Right, so your general journal is one of your books of prime or books of original entry, just like your sales journal, purchase, etc. Now, with the sales journal, purchases journal, returns in journal, they each only record one type of transaction, whatever their name says. Sales journal is credit sales only, purchases journal is credit purchases only, returns in journal is returns in, returns out journal is returns out. Your cash book records all cash and bank transactions, all. Everything that's left goes in your general journal. So you have the purchase and sale of non-current assets on credit, the writing off of bad debts as you're learning about, error correction, which we'll do in probably September or October, and the adjusting entries and closing entries. Right, now adjusting entries have to do with when we have things at the end of a year that need to be adjusted for, like accrued amounts, prepaid amounts, depreciation, etc., provision for bad debts. Closing entries are where we transfer amounts of revenues earned and expenditures incurred for that period to the income statement to calculate profit. Alright? Now, there's also supposed to be a folio column, which I won't worry with because it's almost never used at CSEC. It can be, but I'm not going to worry with it, right? Now, when you're doing your general entry, so let's just record this is for 20XX, right? I know I have 20, actually it was 2021?
Yeah.
Okay, alright, so let's do 2021. We'll do 2021. Right, so let's just assume it's a December 31st year end. Oh. Sorry, give me a second. Okay, fine. So 31st, yeah, right, December, sorry. Right, so the double entry is debit the income statement or profit and loss account and credit the provision for depreciation account. I'm abbreviating because I don't have enough space horizontally. Alright, the amount that goes here would be the same 2,000 from here, and here 2,000 goes there as well. Now, when you are doing journal entries, your debit entries must come first, your credit entry must come second for each transaction, and you'll notice I have a space here. Credit entries must be indented relative to the debit entries. Alright, now in school you all did debit, depreciation expense, and credit provision, right? So I will show that a little later, right? But it's for now, right? And of course, there's supposed to be something called a narrative, which explains what goes on above here, right? So this is to record the depreciation expense for the year. Right. Now, the thing about the journal entry for depreciation with the straight line method is that because it's the same amount every year, if you have to show the journal entries for all 4 years, it would be quite redundant, right? So don't, don't copy down what I'm about to do, but I'll just show you, right? So what would happen, right, is in 2022, it happened again. With the same amount. In 2023, it happened again. And of course in 2024, oh hold on, here's Keely. Let me just look at that. Hey, good afternoon, Keely. How you doing? Good to see you on.
Hey, good afternoon. I'm good.
All right,
Sorry for being late.
Yeah, no worries. I was late too. I started about 1:45, so we only missed about half an hour. All we did so far was talk about the method called the straight line method. We have some notes here which I'll send after class to everybody. Right? After that, we just started in an example. Right? So this is one of the methods of calculation for depreciation in the afternoon. All right? So we explore the journal entries. Now, under this method, we charge the same amount every year. Now, as you can see, we end up making the same entry 4 times. Now, that's pretty redundant, right? So, I won't have you make 4 entries, right? Four of the same entries over and over. What I would do, I would just, now, when you make an entry in 2021, you can't make that entry. When I say you can't write it in 2021 and say this will happen, this entry covers all 4 years. You can't say that. When the entry has to be made in whatever the next year is, make it in again, right? So we will just put that this entry is repeated every year over the assets useful life. You know, one sec. I just want to check how much space. Okay, I think I have enough space. I might not want. Alright, I can just put this here. Right. Now, when we get to the other method, which is the reducing balance method, the amount of depreciation will change every year. In which case, you'll have no choice but to do 4 or how many different entries, right? Sometimes they'll get a little creative and ask you for the entry in the second year, or the third year, or the last year, right? In which case, well, it's just the figure you had to know because the debit and credit will stay the same. So just know what date and what year you're doing and what the amount is. Okay, in class, people, have you any questions on the calculation or the journal entry? Right, now I'll explain a bit more about the journal entry in a little bit, but right now I want to do the T account so I can actually explain a little better. So it's kind of weird because I want to do the T account first, but the T account, as you know, every T account has how many sides? 2, a debit side and a credit side. The journal entries kind of tell us, well, what we're doing when we get to the T accounts. So you're supposed to do the journal entries first, or explain them first. But then, to see the debits and credits, you need the T accounts. So it's a kind of a catch-22 for me sometimes. So most times, if I can, I'll bypass the journal entries because I want you all to see the debits and credits. But then, sometimes they can and they do ask you for, give us the journal entry as opposed to the T accounts. So you have to know how to articulate the debit and the credit for any given transaction. All right. So we'll do more. Well, we'll explain as we go. Right. Okay. So what I want to show you all now is the T account. So once again, this is the calculation. The calculation for the straight line methods depreciation is the cost of the asset minus what we call the scrap or residual value, and then divided by the number of years for which we expect the asset to be of use, right? So 10,000 minus 2,000 gives us 8,000. So just by the way, what that means is we expect to use up 8,000 out of the 10,000. So if we're saying, hey, this is still be worth 2,000, it means we are not going to fully depreciate the asset. We are not going to fully use up the asset, there's nothing left. So we expect that. So this figure here, this 8,000, that actually has a name. It's actually called the depreciable base, right? Not something I think you have to know, but I'll mention it just in case, right? Okay. Does that phrase sound familiar to you all at all? The depreciable base. Okay. I didn't know until Form 6. None of this is Form 6 to know like this, especially. Yeah, that's just what it is. It's the cost minus the residual value. That's the depreciable base. That's the amount total amount of depreciation that will be incurred over the asset's life. This is the value of the asset we expect to use up. Alright, okay. Now for the T account. Alright, so here's my question. Do you all want the T account with the grid lines or without the grid lines? With? Alright. Okay, so as we know we have a date column. So you can put details or particulars. There's also supposed to be a folio column, which again I will omit because we don't do anything with it at this stage right now very often. Sometimes we can, most times we don't. And for the date, I'll put the year. Right, now, I'm probably going to add more deadlines as we go along. Okay. Okay, so the asset is expected to be used for 4 years. And we bought it in 2021 at the very start of the year, January 1st, right? So it's going to be in use for all of 2021, 2022, 2023 and 2024. 4 years. Right? Now I didn't do the asset account. Alright? Okay. Anyhow, so it says here in the journal entry that we debit the income statement, which ends up being in the expenses section, and we credit the provision for depreciation account. So this is the credit side of the account. So when you credit the account, you go on the credit side, you put the amount, you put the other account affected, and you put the date. One second. Right, and this was on the 31st of December. Right. Well, at the end, that is the end of the year. So this is the adjusting entry and the closing entry at the same time. All right. So we have to balance off now. So we have the balance carry down, and the figure there is what, 2,000, right?
Yeah.
Right. So what I'll do is because it's going to be hard to see the double lines, I'll just highlight across in gray to show that that's where we're closing off that year. Not closing off per se, but that's where the end of that year is. Alright? Okay. Oh. Of course. Okay, now, at the end of the first year, we had a balance carried on of 2,000, and of course, if it's carried on from the end of 1 year, it will be brought down at the start of the next year. So 1st of Jan 2022, balance brought down will be 2,000. Okay, so let me pause there and take any questions, right? Okay, so Shiloh, how are you feeling with what's on the screen so far? Do you have any questions, or are we okay with everything? Sorry, say again?
The blue, the highlighted blue thing.
Right, that's just the total.
Okay.
Yeah, because it's going to be difficult for me to show the double line that we would normally show me closing off that year end. That's how we're going to show like the total line now.
Okay.
Okay? Alright. Alright, Kaylee, how are you feeling? I know you kind of came in late and I missed a couple of things. Are you okay, or you need me to re-explain anything a little bit more?
I'm okay because I did this in school already, so it's just kind of like a review for me.
Okay, good, good. Right. Of course, if you have any questions, you're more than welcome to ask, alright? Shannon, how you feeling?
Okay, so no
But
matter.
I just have one question.
Yeah.
So when you put income statement at the start, how come you put in 31st of December, not the first of Jan? Is it because they say at the end of
Yeah.
that time?
Right. So what we are assuming that we bought the asset on 1st of Jan 2021, right? So I really should have said that the year end was 31st of December. I
Yeah.
just kind of assumed. So yeah, no. So I should have stated that explicitly. Sorry. So yeah. So the depreciation adjustment takes place usually at year end, whenever you're drawing up your financial statements, right? Now it is quite possible to accrue your depreciation as time goes on, like every month or so. That's perfectly normal, perfectly fine, right? But this is at the very end of the year. What would happen is we would transfer the whole amount to the income statement.
Okay.
All right. All right. Hilly, what about you? Any questions? Are we okay? Or all right. Now we talking good there? Okay, cool. Okay. Now in the second year, guess what? We have to charge depreciation again. And guess what? We charge the exact same amount as last time because we are using the straight line method. And under the straight line method, we charge the same amount for depreciation every year. Alright, so now, at the end of the year, the total balance carried down is 4,000. It's 2 years now. It's now 2 years worth of depreciation. And what happens thereafter is you bring your balance down again. Right, so I'll hold up pause there for a couple of seconds if anybody's copying some stuff down or if anybody has any questions. Right. Ready? Okay. So in the third year, we have to charge depreciation again. And guess what we do? We charge the same amount. Mhm. So at the end of the year, we have now have 6,000 in total. And in 2024, yeah. Oh, we've blanked off. Back up now? Yeah. Okay, thank you. Alright. And then I'll copy and paste the whole year 4. Alright, so in year 4, we brought down 6,000, we charged 2,000 again, and the total now is 8,000. Right, so I won't worry to show the balance brought down in 2025. And because what is supposed to happen at the end of an asset's life is that we dispose of the asset. We get rid of it, we sell it off. Okay, you want again? Alright guys, just now, something's going on. Right, so I can still see it online, so I know Shiloh and Keely is seeing it as well as online people them. Yeah, so I'm not sure what's going on with the in-class stuff, maybe with the codes. Anyhow. Yeah. Right, so sorry. Yeah, so as we could see here, every year we charge the same amount of depreciation. Right, so it accrues uniformly every year. Okay. So what I want to do is I want to give you guys one to try. So a calculation and a T account. And after you guys do that, we'll talk about the financial statement aspects of it, the income statement, and then the balance sheet. Alright? right? Now the income statement is actually like the other half of the entries here, right? So we're seeing items on the credit side here saying income statement. So if we're crediting the provision account, that means that the income statement is debited, which we of course saw in the actual journal entry, right? But of course the income statement is not really an account per se. It used to be called the trading and profit and loss account. It used to have debits and it used to be in a T account format. But then when they had to publish accounts, they started to do a vertical format. So that's what we learned, right? Yeah. Anyhow, so it might have been helpful to do the income statement side by side, but this is how I did it this time. Anyhow, so what I want to do is I just want to check with Kaylee and Shiloh. So Kaylee and Shiloh, just give me a quick G in the chat if you're good with the T account. Right, so if you're good with that, give me a G in the chat. If you need me to re-explain anything, give me an R. Right, or if you want, you can even just use the emoji stuff here and send a thumbs up or a thumbs down. Alright, cool. Alright, so all you're doing here is you are accruing. Why does that word sound wrong all of a sudden? Right, accruing the depreciation on the asset over its useful life every year. And because it's a straight line method, it accrues evenly, or we incur the same amount every year. Right, so it builds up at the same rate, 2,000 a year. After 4 years, you therefore have a total of 8,000, which of course, as we said, matches what we call the depreciable amount. Alright, so I'm going to kind of copy. Alright, so this is classwork one. Did it blank off again? No, I heard some kind of something. Alright, so you don't have to write out like the whole thing here, but I just want to copy the major information, the cost, the residual value, and the EUL, and of course state straight line method, right? So let's change it from fixtures. Alright, let's change this value. Hey, what value you want here? Alright, okay, pick a number between 10 and 20. 10. But we just use 10, so other than 10, no? 12? Alright, cool. So we purchased some fixtures at 12,000 or costing 12,000. Right, on the 1st of Jan, let's say 2022. And it is believed that they will last for 4 years and be worth, let's say, 4,000. Let's say 2,000 at the end of that time. So yeah. So of course these figures down here are the figures you want to use. Alright, so yeah, so the cost of this asset, the fixtures, is 12,000. The residual value is 2,000, and we're going to use it for 4 years. Alright, so I want you all to do just the first two things for me, right? You're going to calculate the depreciation expense and then just draw up your journal entry. that's stating explicitly that the company's year end is 31st of December, right? Alright, let's plug in some figures here. I can do the calculation, and we still do the calculation. Alright, we have 12,000 minus 2,000 divided by 4, right? So this will give us 10,000 divided by 4, which is how much? 2,500 per year? Alright, cool. Right, and then the general journal entry will be exactly like this here. We'll use right, 2,500 instead. Okay, how are we feeling so far with the stuff on the screen here? Any questions? Any problems? No, just that first one. Yeah. Yeah, because it's a straight line, right? Alright, Keely, how are you feeling with that? And Shiloh?
I'm okay so far.
Alright, good. Alright, Shiloh, we okay with that one?
Yes, sir.
Alright, lovely. Okay, so what I want you guys to do is fill out the T account now. Alright, so of course it wouldn't be this figure. I think I was saying something earlier. Yeah, so at the end of the useful life, when the asset is used up, it's supposed to be disposed of, which means it's sold off, right? Or just basically gotten rid of. Disposal used to be on the syllabus, but was taken off about 20 years ago, right? It wasn't a hard aspect as far as I'm concerned, right? Once you follow, there's a couple of steps to follow, but they removed it. Who knows why? They probably figured, well, people were getting it wrong, or I don't recall seeing it very much on the exams. Maybe so, but we're not testing, so take it off. Anyway, that's a different concept. The funny part is, a couple of years ago, I think last year, May 2024, the last question had a bunch of T accounts and double entry. And one of them was the entries to record the sale of a non-current assets. Right? And at a profit on top of that. So I'm like, well, we're supposed to use the disposal account. right? You were also supposed to involve the depreciation account in that, but that didn't happen. So I find it strange that they brought that particular item. But again, it was one entry out of about a dozen in the question. So even if you didn't get it completely right or you left it out entirely, you wouldn't have suffered much. Because on top of that, you weren't asked to balance off the accounts. You weren't asked to extract a trial balance. And even if you were asked to do that, and everything else was right, you could have kind of figured out the amount to balance it off, you know? But again, they do some weird things. Alright, so I'll give you a couple minutes again. And I'll just kind of populate the whole thing one time. Let's put in some formulas to put into that. Oh, interesting. Okay. Right, so I'm gonna populate that stuff very, very soon. Okay, so the amount, okay, it blanked out again. Not entirely sure why. No signal. Not sure what's going on. It had to be from that. that because that's where it's coming from. Not good. Anyhow, we'll see how that progresses. Okay, so the amount for the depreciation every year was how much? 2,500, right? So cool, there you go. 2,500 in the first year, right? That's the balance carried on to the second year, and we charge the same amount again. Now, two amounts of 2,500 will total 5,000, so that's the balance carrying on now to the third year. We charge 2,500 again, the total is now 7,500. That balance is carried on to the fourth year. You charge one more time, and your total is 10,000. That's it. Okay, how are we feeling with that stuff? Yeah? Alright. Shiloh, how are we feeling with that?
Yes, sir.
Alright. Kaylee, you cool with that too?
Yeah, I'm good with that.
Alright, lovely. Okay. And Haley, what about you? Okay. Right, so guys, I know we don't have too much time again, so again, not your fault, all mine. But what I want to do, I want to show you all how to do the income statement extract and the balance sheet extract. Now, I'm going to go back to the example. Alright. Can I do this on this page, boy? Okay. Right, so, the income statement extract, right, for the years ended 31st December, right? Now, if the company or entity had a name, you would put the name, of course, right? Okay, so, oops, no, what we'll do, oh, no, alright, so let's explore, an extract is a small piece of a whole, so all we're doing here is we're showing specifically the entries regarding depreciation in the income statement, right? So this would be the provision for depreciation on the, what do you call it? The furniture, right? If you guys can fit it in one line, then please do. I clearly can't. Right, so we have 4 years, right? Right, and the amount is the same 2,000. Right, now normally I would tell people to put 2021 to 2024 and just put one line. However, I have since changed my thoughts on that, and I prefer you all to show, even though it's the same figure, over 4 years, show them differently. Because when we get to the
So it's not like fire.
smoke,
Yeah.
I thought I was something a little bit, but still, yes. You know anything?
No, it's just not like gas in the fire.
Oh, gas.
Oh, yeah. So it's not like gas, like gas station. And inside there's no like wood, like fire.
Oh, it is possible that my dad is doing something on the outside on that side. I can check.
No, no, no.
Alright.
I don't think it was like.
Oh, inside of here.
Yeah.
Right. Now for the balance sheet extract, I'm going to have to actually I could show it there. Right. Okay, now when we are dealing with depreciation in the balance sheet, we have 3 columns. The cost, the depreciation, or normally you'll put either accumulated depreciation or provision for depreciation, but I just put that because I don't have much space, right? And then the last one is the NBV, which stands for net book value. What the net book value is simply the cost of the asset minus the depreciation, right? So we're going to head up non-current assets, and well, in this case it's only furniture, right? Right, So the copy this second across here. Right. So the cost of the asset doesn't change. So this column have the same figure for how many of the years? Now how much? It was 10,000, right? In the example. Now the balance sheet will pull the balance from the account, right? So at the end of the first year, we had how much in depreciation? 2,000, right? So the first year, you're gonna have 2,000 here, right? Now you don't have to show it in brackets. You don't have to put a minus sign. I put that for me as a visual cue to remember, hey, I'm subtracting. You don't have to. If you want to, you can, right? And you subtract. Whoops. Right? So 10,000 minus 2,000 is 8,000. Now in 2022, the cost of the asset is still 10,000. You've neither bought more nor sold some of it, right? But at the end of year 2 now, the balance in the depreciation account is 4, which is 2 years worth of 2,000. What's so? Hold on. And 10 minus 4 is 6. In year 3, the cost is still 10,000. The depreciation at the end of year 3, however, is 6,000. 10 minus 6 in year 3 will give us 4. Hold on, just now. Just realized TikTok not getting anything. That is weird. It's stuck on a screen from like half an hour ago. That's weird. Okay, I guess I'm gonna end this stream here. Not sure about that. Yeah. Okay. Right, and in the final year, we have 10,000, and the total for depreciation at the end of the fourth year is 8,000. And of course, 10 minus 8 is 2,000. Alright? Right, now I know we only have like about 2 minutes left for class. Right? So I don't know that you guys could do both of these things for the question. You will just, okay, let's blank off again. One sec. Well, at least my online people see me, right? Okay. So my head kind of blocking. Okay, my head kind of blocking. So I'll just move this across a little bit. Actually, I'll go up. Right. Yeah. It's gonna blank off. Let's give it a sec. Oh, it didn't blank out? Okay. How fun. So maybe it was this thing, because this thing had a problem. Okay. So what I would invite you all to do, now again, I don't like to assign homework because I know you'll have plenty of things to do from school. But I would encourage you to do the extracts for the financial statements for the question you guys did, where you had a depreciation of 2,500 per year. Alright? You can send me a picture when you're done. Right? It doesn't have to be today, but the sooner you do that, because you're probably going to forget. Right? Now, like I said, I intend to have this class next week, and I intend to start on time and not lose 45 minutes or more. Right? So next week we're going to probably just correct that if I didn't correct it before, and then we're going to go into the reducing balance method. Right? Now, the reducing balance method is a little more involved. It's not, as some people like to say, hard, right? The biggest difference between the two methods is, well, apart from the calculation, is that the depreciation charge under the reducing balance method changes every year, right? Reducing means what? Going down or decreasing. So you have a decreasing amount of depreciation every year, and that, like I said, this method was suitable for assets that kind of gave us the same benefit year in, year out, and wore out evenly. But we have assets that don't do that. They wear out, they give us more benefits earlier on, and the benefits we derive are less and less. So that method is more suited for those types of assets, like motor vehicles, electronics, and whatnot. Sorry? Oh, right. So all that will happen is that instead of having the same figure every year, or this growing by the same amount, is that this will differ every year, and well, this will not grow by the same amount. That's the motive.
So that's why it's not the same answer when you do both of these.
Not usually. It's very. Is it even possible? I'm sure it's possible mathematically somehow, but I've never seen it.
Because I was always confused on when we used to do it in school. why it would never be same answer.
Oh, no, it wouldn't be. Not likely. I guess you could somehow manipulate your rates. Like if you have a different rate under each one. If you use the same rate, the same percentage, then yeah, it would never be the same. Maybe at the end of the first year, but thereafter, no. Alright, okay. Alright, so Kaylee and Shiloh, that's about it for today. So I will send a link to the replay of this so you can always watch it over. And I'll send a PDF of what we did. And I also will probably put in the answers to what I asked you all to do, so you can always check it yourself, and I'll send it the PDF. Alright? But closing up shop now. If my plan to have class next week is not going to come true, I will let you know in advance. And like I said, from the week after, we could continue once a week, or if you want to put in any extra days, again, that's not mandatory. It's up to you all. If you all have space and time, I probably will, right? To put in another extra push for the exam, right? And yeah. So yeah, that's about it. Alright, so Kaylee are gone, Shiloh are gone, have a good weekend. And if you guys need any help between now and then, please feel free to WhatsApp me. Once I have time, I'll get back to you, okay? Bye.
Bye, sir.
Maybe the only thing that's a bit like that
Mhm.
I'm not confused with is why the cost still stays at the 10,000. Because I would have put the 8,000.
Right, but that would be the net book value, right? When we're doing the calculation for the reducing balance method, that's what's going to happen.